Success in trading is not an event. It's a gradual transformation that happens in layers, each stage stripping away illusions and replacing them with clarity. Most traders enter the markets thinking they already know what it takes to win. They believe strategy is everything, that one perfect setup will erase all their mistakes, and that discipline is simply a matter of willpower. But as the market begins to test them, reality unfolds. Trading success has less to do with predicting price and everything to do with understanding your own behavior inside an environment of uncertainty. The journey begins with confusion, not because the markets are unclear, but because the trader is. We carry expectations into every trade. Expectations built from past wins, past losses, personal desires, and the need to be right. At the first stage, these expectations collide with the market's indifference. The trader realizes that the market doesn't reward effort, intelligence, or intensity. It only rewards consistency in decision-making. This stage is where most people quit, not because the market is too hard, but because the emotional cost of facing one's own impulses is heavier than anticipated. The second stage evolves when the trader starts recognizing patterns, not in price, but in themselves. They begin to see how fear shows up disguised as hesitation, how greed enters as hope, and how frustration pushes them into overtrading. They learn that trading is a mirror reflecting their mental structure. Every impulsive click, every premature exit, every shaky hand hovering over the mouse comes from deeply rooted beliefs about risk, loss, and uncertainty. In this stage, the trader is still inconsistent, but something powerful begins to emerge: self-awareness. And in trading, self-awareness becomes a structural edge. With awareness comes the foundation for mastery. The third stage is where the trader stops fighting the market and starts aligning with it. They accept randomness without fear, losses without emotional disruption, and gains without arrogance. They cultivate an internal balance that allows them to see opportunities objectively, free from the weight of past outcomes. Instead of reacting to the market, they respond. Instead of seeking certainty, they manage probability. Their decisions become deliberate, consistent, and nearly emotionless, not because emotions disappear, but because they no longer control behavior. This final stage transforms trading from a chaotic struggle into a structured process. The trader develops trust, not in predictions, but in their ability to execute flawlessly. The market no longer feels threatening because nothing within it can violate their mental equilibrium. They understand that success is not achieved by eliminating risk, but by learning to coexist with it without distortion. And within this mindset, the trader begins to experience what few ever reach: a flow where the market's movement becomes information, not intimidation. Becoming a successful trader is not a matter of time, luck, or talent. It is a progression through these stages: confusion, awareness, and mastery, each one shaped not by the market's behavior, but by the trader's transformation. Mastery in trading begins at the moment a trader no longer allows emotional reactions to dictate decisions. This is the turning point where the internal chaos that once controlled every entry, exit, and hesitation loses its power. To understand why this shift is so fundamental, you have to first understand the nature of emotional influence in trading. Emotions do not appear out of nowhere. They arise from deep-rooted beliefs, expectations, fears, and mental associations built long before a trader ever opens a chart. Every emotional reaction you experience in the market is a reflection of something inside you, something that wants certainty, validation, or protection. The market, of course, offers none of these. Not to you, not to anyone. It provides movement, opportunity, and risk, nothing more. So when a trader relies on emotional impulses to make decisions, they are essentially trying to impose personal needs on an environment that has no mechanism for fulfilling them. This is why emotional trading is always destructive. Fear, for example, can make a trader exit too early, avoid taking valid trades, or freeze at critical moments. But fear is rarely about the chart itself. It is about the internal meaning assigned to loss. A trader who fears losing is not afraid of the loss. They are afraid of what they believe the loss says about them. Maybe it represents failure, incompetence, or a threat to their self-image. When this meaning becomes attached to a trade, every fluctuation on the chart becomes emotionally charged. A mere pullback feels like danger. Every small red candle feels like a personal attack. And the mind begins crafting stories to protect the ego. These protective reactions override logic, analysis, and probability. The trader exits early not because the setup is invalid, but because the emotion is too overwhelming to sit through. Greed operates differently, but is born from the same internal structure. When a trader feels greed, it is not simply the desire for more profit. It is the emotional attachment to the idea of reward. The trader imagines a future where the trade becomes the one big win that changes everything. In this state, logic collapses. The stop is moved, the target is abandoned, and the trade becomes a desperate attempt to satisfy an emotional craving. The trader is no longer responding to the market, but to the fantasy they constructed. When the trade reverses, panic sets in, and another emotional reaction takes over: regret, frustration, or self-blame. The cycle repeats, reinforcing patterns of impulsive behavior. Anger is another force that takes control. When a trader is emotionally attached to outcomes, anger arises when the market does something the trader believes it should not have done. This is a clash between expectation and reality. A trader who is angry at the market is really angry at themselves for believing they could control or predict what happens next. But instead of acknowledging this, the anger is projected outward. This projection leads to revenge trading, oversized positions, and rapid-fire decisions made solely to regain emotional equilibrium rather than follow a plan. In this state, the market is no longer seen objectively. It becomes an opponent to defeat. And when the market becomes an enemy in your mind, you lose the clarity needed to operate effectively. When emotional reactions run the show, the trader becomes inconsistent. They might have a solid strategy, a tested system, or years of market knowledge, but their results remain unpredictable. This unpredictability has nothing to do with the market and everything to do with the trader's inability to operate from a stable mental state. The trader is essentially gambling with their emotional stability, waiting to see which feeling will dominate their next decision. No amount of technical skill can compensate for this lack of internal control. Even when they try to force discipline, emotional pressure eventually breaks through. Discipline rooted in willpower alone cannot withstand the weight of unresolved emotional beliefs. Mastery begins when the trader stops giving these emotions authority. This doesn't mean emotions disappear. Emotions are natural, automatic, and deeply ingrained. What changes is the trader's relationship to them. Instead of acting on the emotion, the trader observes it. Instead of reacting impulsively, they pause and evaluate. Instead of interpreting discomfort as a signal to exit or enter, they recognize it as a natural response to uncertainty. When a trader reaches this level of awareness, emotions lose their controlling influence. They may still appear, but they no longer dictate behavior. The trader has created enough internal space to separate the feeling from the decision. This shift requires a restructuring of beliefs around risk, loss, and uncertainty. A trader who truly understands risk knows that every trade is just one of many, that any outcome is possible, and that no single result carries personal meaning. When losses lose their emotional weight, fear loses its leverage. When wins are not tied to ego, greed loses its pull. When expectations are detached from the outcome, anger has nothing to attach itself to. This is why emotional neutrality becomes such a powerful form of mastery. It doesn't numb the trader, it liberates them. Without emotional interference, the trader can see the market as it is, not as they want it to be. They can execute their plan without hesitation, follow probability without resistance, and hold trades without the internal battle that once consumed them. Their decision-making becomes cleaner, sharper, more consistent. Every action becomes intentional rather than reactive. This is the point where trading transforms from chaos to structure. Patterns become clearer, rules become easier to follow, and outcomes become more stable. The trader no longer needs the market to validate them. They no longer depend on wins to feel good or losses to feel bad. They act from a mindset grounded in logic, probability, and neutrality. In this state, mastery emerges naturally, not because the trader forces it, but because nothing internal blocks it anymore. Emotions still exist, but they no longer sit in the driver's seat. The trader now operates from clarity instead of impulse, from awareness instead of ego, from structure instead of emotional necessity. The market reflects your mindset more than your strategy because every chart you see, every signal you interpret, and every decision you make passes through the filter of your internal beliefs. You might think you are analyzing price action objectively, but in reality, what you see is shaped by what you expect, fear, desire, or assume. Two traders can look at the same candlestick pattern and come to completely different conclusions, not because the market is ambiguous, but because their mental frameworks are different. One sees opportunity because they are trained to recognize probability. The other sees danger because they've been burned before. The chart itself hasn't changed, the interpretation has. This is why trading results vary so drastically from trader to trader, even when they use the same system. The system is the same, but the mindset behind it is not. Your mindset determines how you behave under pressure, how you respond to uncertainty, and how you interpret the information the market gives you. If your mindset is driven by fear, every fluctuation will appear threatening. Small pullbacks will seem like reversals, and normal volatility will feel like chaos. Your eyes will begin searching for reasons to exit trades prematurely because fear cannot tolerate open-ended outcomes. You will see every red candle as confirmation of your internal belief that something is about to go wrong. This mental bias causes you to misinterpret what the market is actually doing. Even if you understand technical analysis intellectually, your fear distorts the signals until they align with what you emotionally expect. The market becomes a screen onto which your internal anxieties are projected. If your mindset is shaped by greed or emotional hunger for validation, you will see opportunity where none exists. Every small move will look like the beginning of a massive trend. Your desire for a big win will magnify setups and make weak signals appear strong. Instead of seeing structure clearly, you will see what you want to see. Greed alters perception, making you blind to risk and overly confident in outcomes. You start to believe that your trade must work simply because you want it to. When the market contradicts you, instead of adjusting, you double down, hold longer, or refuse to accept loss, because greed refuses to release the fantasy it created. The mindset alters perception so powerfully that you reinterpret data to justify your emotional attachment. A mindset rooted in the need to be right creates another powerful distortion. Traders who cannot accept being wrong interpret every signal defensively. Instead of analyzing what the market is doing, they analyze how the market affects their self-image. They enter trades late because they wait for too much confirmation. They exit early because they fear being proven wrong. They hold losing trades because acknowledging a bad decision feels like an attack on their identity. The market becomes a personal judgment system rather than an environment of probability. This mindset filters out neutral information and amplifies anything that feels confrontational. The trader sees the market not through price action, but through the emotional need to maintain internal correctness. Even confidence, when misplaced, can distort perception. Overconfidence makes a trader ignore warning signs, break rules, and assume they understand the market better than they do. Instead of recognizing the randomness of outcomes, they begin to believe their intuition is superior to logic. This mindset leads to poor risk management, oversized positions, and excessive trading. The trader stops seeing the market as a dynamic, uncertain environment and begins to view it as something predictable. The illusion of control replaces objective analysis. When the illusion breaks, the emotional fallout is severe, and the trader often swings from confidence to fear, creating even more instability. A neutral mindset, however, reveals the market with far greater clarity. When you are not afraid of losing, not hungry for winning, not attached to being right, and not trying to force outcomes, you begin to see what is actually happening. A neutral mindset allows you to interpret data without distortion. You no longer impose your personal expectations onto the chart. You can evaluate setups based on probability instead of emotion. You can enter and exit without hesitation because your decisions are not tied to your identity or emotional state. A neutral mindset makes you receptive to whatever the market is communicating rather than resistant to it. This is why traders with the same strategy produce different results. One trader applies the strategy from a place of emotional desperation, insecurity, or impulsiveness. Another applies it with consistency, discipline, and emotional neutrality. The strategy itself does not decide who wins. The mindset decides, because the mindset controls execution. A strategy is only as effective as the trader's ability to apply it without distortion. Every rule, every method, every entry signal depends on the trader's capacity to follow it faithfully. Without the right mindset, the same system that made someone else rich can ruin you. Your mindset also shapes how you perceive risk. A trader who fears risk will avoid high-quality setups simply because they feel uncomfortable. A trader who craves reward will take low-quality setups simply because they feel exciting. A balanced mindset sees risk as a natural part of trading, not something to avoid or chase. Risk becomes a structural component of the system rather than an emotional event. This neutrality allows for logical position sizing, consistent stop placement, and disciplined trade management. Mindset influences expectations, and expectations influence perception. When you expect the market to give you something, a win, validation, relief, you stop seeing what is there and begin seeing what you want to see. This creates a psychological gap between reality and interpretation. Trading inside that gap leads to missed opportunities, premature exits, reckless entries, and emotional spirals. The market becomes a battlefield not because it is hostile, but because your internal world is chaotic. The moment the internal chaos settles, the external environment becomes clearer. Ultimately, the market behaves the same way whether you are calm, afraid, confident, or confused. It does not change. The only thing that changes is your ability to read it accurately. And that ability is determined entirely by your mindset. Consistency is built through discipline, execution, not predictions, because the market does not reward how accurately you guess what might happen next. It rewards how well you manage what actually happens. Traders often enter the market with the belief that the key to success lies in forecasting future price movements with precision. They invest enormous amounts of time searching for the perfect indicator, the flawless pattern, or the holy grail system that will eliminate uncertainty. But the market cannot be mastered through prediction. Uncertainty is woven into every tick, every candle, every trend. No system, no matter how advanced, can eliminate randomness. What a trader can control, however, is their behavior. And it is the consistency of that behavior, executing the same rules, managing risk the same way, responding to setups the same way, that creates stability in results. When a trader relies on predictions, their performance becomes inconsistent because predictions are influenced by emotion, bias, and the illusion of control. You may predict correctly several times, but you will also be wrong, and the emotional impact of being wrong often leads to impulsive behavior. One wrong prediction can trigger hesitation, causing you to exit early or avoid the next setup. Another wrong prediction may provoke frustration, leading to revenge trades or oversized positions. Prediction-based trading creates a fragile mental environment where confidence rises and falls with every outcome. This makes stability impossible. You begin to chase wins instead of following rules. You rely on hope instead of structure. You act from emotion instead of probability. Disciplined execution removes this instability. It shifts the trader's focus from trying to control the market to controlling themselves. When you commit to executing your plan the same way every time, your decisions become consistent regardless of external circumstances. The market can be volatile, trending, choppy, or range-bound, but your internal process remains the same. You are no longer reacting to every fluctuation, you are following a method. This shift in focus is what transforms randomness into manageable probability. A trading system does not work because it predicts the future. It works because it provides a repeatable framework that yields an edge over many trades. That edge only appears through discipline. Without discipline, even the best system collapses. Discipline, however, is not rigidness. It is not about forcing yourself to obey rules through sheer willpower. True discipline is the result of accepting the nature of the market and understanding the role you play within it. You follow your plan because you have internalized that deviation leads to emotional decisions, and emotional decisions destroy consistency. Discipline becomes the natural outcome of mental alignment. You no longer feel the urge to gamble or improvise because you recognize that your long-term success depends on repeating the same quality actions over and over, independent of outcome. Consistency also comes from understanding that each trade is just one event in a long series. Predictive trading treats every trade as though it has enormous meaning. Traders become emotionally attached to individual outcomes, putting too much weight on a single moment. This creates pressure, which distorts decision-making. When you execute with discipline, you detach from the outcome because you know that no single trade defines your performance. Your job is not to win every trade, but to execute your edge consistently. Over a large sample size, your disciplined behavior allows probabilities to play out. Inconsistent behavior, on the other hand, destroys the statistical foundation of your system. You end up with random results because your actions are random. Disciplined execution shapes a mindset of neutrality. When you follow rules, emotions lose their grip. There is no room for fear-based exits or impulsive entries. The rules act as a filter against emotional interference. You no longer need to predict because you trust your edge. You no longer need certainty because your behavior provides stability in an uncertain environment. This internal stability is what gives you the clarity to see the market objectively. When you're not trying to force outcomes, you begin to recognize opportunities more cleanly. You follow the process rather than chasing results. Much of a trader's inconsistency comes from altering their method based on recent experiences. After a loss, they become more cautious. After a win, they become more aggressive. After a series of setbacks, they tweak their strategy without giving it enough time to play out. Prediction-based thinking fuels this behavior. You judge your process based on short-term outcomes rather than long-term probability. Discipline breaks this cycle. It keeps you aligned with the plan, regardless of temporary fluctuations. You do not change your method because of a losing streak. You evaluate it based on structure, logic, and data, not emotion. You do not shift to random trades because the market appears tempting. You act only when your rules signal a valid opportunity. Consistency also requires the trader to define their rules clearly. Many traders think they have a strategy, but what they actually have is a loose set of ideas, flexible enough to be influenced by emotion. Discipline cannot exist without structure. You cannot execute consistently if you do not know exactly what you are executing. A precise entry criterion, a fixed risk parameter, a predefined exit plan, these create the framework within which discipline thrives. Without them, you will always slip into subjective decision-making. Prediction fills the gaps left by vague rules. When your system is unclear, your mind fills the uncertainty with emotional impulses disguised as intuition. Strict, clear, structured rules eliminate this mental loophole. Disciplined execution builds confidence. Not confidence in prediction, but confidence in your ability to behave consistently. This form of confidence is sustainable because it is not tied to outcomes, it is tied to your process. You begin to trust yourself because you know you will show up the same way every time. This self-trust is one of the most powerful psychological edges a trader can have. When you trust your execution, hesitation fades, fear weakens, and doubt loses its influence. You move from reactive trading to objective trading. Decisions feel lighter, cleaner, and more deliberate. Over time, disciplined execution creates a smooth equity curve, not because every trade wins, but because each trade is part of a controlled, structured system. Even losses become productive, because they are within the parameters of your plan. You stop seeing them as personal failures and begin seeing them as normal components of your edge. This mindset keeps you steady during drawdowns. You do not panic, you do not abandon your system, and you do not fall back into prediction-based gambling. You remain stable because your behavior is stable. Prediction may give temporary excitement, but it never produces long-term success. Discipline may feel less thrilling, but it produces results that accumulate, compound, and stabilize. The traders who succeed are not those who predict best, they are the ones who execute best. They show up consistently, follow their plan consistently, manage risk consistently, and behave consistently. Over time, this consistency becomes the very engine that drives their growth. Probability thinking replaces the need to be right because trading is not a game of certainty, it is a game of possibilities. Every price movement is influenced by countless variables, most of which are unknown, uncontrollable, and constantly changing. When a trader approaches the market with the belief that they must be right on every trade, they place themselves in direct conflict with the nature of uncertainty. This creates emotional pressure, cognitive distortion, and impulsive behavior. The need to be right is rooted in ego, identity, and the desire for control, none of which align with the fluid and unpredictable nature of market behavior. Probability thinking removes this conflict by shifting the trader's focus from outcome perfection to process consistency. When you think in probabilities, you understand that any single trade is just one event within a larger series of trades. Each trade has an uncertain outcome, but over a large sample of consistent executions, your statistical edge becomes meaningful. This transforms your relationship with the market. You no longer attach emotional value to individual wins or losses. A loss is not a personal failure. It is simply one instance where the probability did not unfold in your favor. A win is not a validation of your superiority. It is just one instance where the conditions aligned with your edge. This mindset protects you from the emotional roller coaster that destroys discipline. You stop trying to forecast exact outcomes and instead focus on managing risk, recognizing setups, and following your plan without hesitation. Thinking in probabilities allows you to see the market objectively. When you are obsessed with being right, you interpret data through the lens of expectation. You look for information that supports your belief and ignore evidence that contradicts it. This creates confirmation bias, a dangerous psychological trap that blinds you to what the market is actually communicating. In contrast, a probabilistic mindset encourages open observation. You examine the chart for what it is, not what you want it to be. You understand that even perfect setups fail and weak setups sometimes run. Instead of forcing certainty onto the chart, you allow flexibility. You accept that anything can happen, and this acceptance gives you clarity. The need to be right also creates emotional attachment to trades. When you believe you must win, you hold losers longer than you should because closing the trade feels like admitting defeat. You take profit too early because securing a small win feels safer than risking being wrong. This emotional interference collapses your risk-to-reward ratio, breaks your rules, and destroys your consistency. Probability thinking eliminates this emotional burden. You follow your stop loss not because you like it, but because you understand it as part of the statistical structure of your edge. You hold your winners because you know that over many trades, letting winners reach their targets is essential for profitability. By removing attachment to any single outcome, you remove the destructive emotional patterns that sabotage long-term success. Probability thinking also enhances risk management. When you view trading as a probability game, you naturally begin to think in terms of risk versus reward. You understand that your job is not to protect every trade from loss, but to ensure that the average outcome over many trades is positive. This perspective helps you size your positions appropriately, place your stops rationally, and avoid unnecessary risk. Traders who think they must be right often increase their position size to chase quick victories or recover losses. This behavior leads to catastrophic drawdowns. A probabilistic trader, however, treats every trade as part of a controlled system, ensuring risk remains consistent and manageable regardless of emotional impulses. Another powerful benefit of probability thinking is that it reduces fear. Fear arises when you try to control something you cannot predict. When you think you must know exactly what will happen next, every fluctuation becomes a threat. Every pullback feels dangerous. Every consolidation feels like uncertainty, and every small reversal feels like the beginning of failure. Probability thinking frees you from this mindset. You no longer need to know what will happen, you only need to know what you will do when it happens. This removes the emotional weight of uncertainty. You can calmly watch price move in any direction because you already understand your possible actions. Fear weakens when your decisions are grounded in predefined rules rather than emotional guessing. Probability thinking also helps you adapt to changing market conditions. When you abandon the need to be right, you become more flexible. You can shift between trending and ranging environments because your decisions are not tied to a single rigid belief. Traders who cling to predictions resist change. They fight the market because admitting a shift in conditions feels like admitting they were wrong. This creates hesitation, confusion, and losses. Traders who think in probabilities flow with the market. They accept that conditions, evolve, and adjust their behavior accordingly. This adaptability becomes a competitive edge because it keeps them aligned with the current structure rather than trapped in a past assumption. A probabilistic mindset fosters patience because you no longer feel pressured to trade constantly. You wait for setups that fit your rules because you understand that your edge appears only in specific conditions. Traders who operate from the need to be right often overtrade. They chase setups that are not part of their system out of desperation to prove something to themselves. Probability thinking dissolves this compulsion. You trade less, but you trade better. Each execution is deliberate, structured, and aligned with your edge. Finally, probability thinking empowers you to develop emotional resilience. When you detach your identity from outcomes, losses stop hurting your ego. They become informational rather than emotional. You analyze them constructively instead of defensively. You no longer spiral after a losing streak because you understand that drawdowns are part of every legitimate system. You no longer become euphoric after a winning streak because you know it is simply the favorable side of probability playing out. This emotional neutrality strengthens your discipline and keeps you balanced through the inevitable ups and downs of trading. By replacing the need to be right with probability thinking, you become free from the psychological traps that sabotage most traders. You stop fighting uncertainty and start managing it. You shift from ego-based trading to process-based trading. You transform your execution from reactive to consistent. And through this shift, you build the mental foundation required for long-term success in the market. Self-awareness is the foundation of long-term success because every decision you make in the market originates from your internal world. Your beliefs, fears, impulses, assumptions, and emotional patterns. A trader may spend years mastering technical analysis, memorizing strategies, and studying market structure. But without understanding themselves, they will always remain vulnerable to the psychological forces that influence their behavior. The market does not test your intelligence. It tests your emotional stability. It exposes your weaknesses, magnifies your internal conflicts, and forces you to confront aspects of yourself you may never have noticed. Long-term consistency becomes possible only when you understand who you are inside the uncertainty and pressure of trading. This is why self-awareness becomes the deepest edge a trader can develop. When you are not aware of your internal patterns, the market becomes a trigger for unconscious behavior. You might believe you are making rational decisions, but in reality, your actions are shaped by emotional impulses. Fear can make you exit too early or avoid valid setups. Impatience can push you into trades that do not fit your plan. Greed can convince you to hold beyond your targets or trade oversized positions. The need for validation can lead to revenge trading or chasing losses. All of these reactions happen automatically if you lack the self-awareness to recognize the emotional signals before they take control. Without awareness, emotion becomes the driver and logic becomes the passenger. Self-awareness allows you to identify these patterns as they occur. Instead of acting on the emotion, you can observe it. Instead of letting fear whisper that something is wrong with a trade that is still valid, you recognize the fear as a conditioned response, not a market signal. Instead of letting greed inflate your expectations, you can catch yourself imagining fantasy outcomes. Instead of letting frustration push you into reckless decisions, you can acknowledge the frustration and return to your plan. This internal observation gives you the ability to pause, reflect, and realign with your rules. It is the pause, created by awareness, that prevents impulsive trading and protects your consistency. Self-awareness also reveals the deeper beliefs that shape your trading identity. Many traders unknowingly carry limiting beliefs: fear of loss, fear of missing out, belief that success requires perfection, or the belief that one must always be in control. These beliefs create hidden pressure. A trader who fears loss views each trade as a threat. A trader who fears missing out jumps into setups without confirmation. A trader who believes they must always be right takes trades personally and resists objective analysis. Without awareness of these beliefs, they operate in the background, influencing behavior automatically. Only by recognizing and questioning these beliefs can you reframe them into healthier ones that support your trading goals. Awareness extends beyond emotions and beliefs into behavioral habits. You begin to notice your tendencies. Do you overtrade after a win because confidence becomes excitement? Do you hesitate after a loss because self-doubt takes over? Do you frequently move your stop because discomfort becomes unbearable? Do you break your rules when the market moves fast because urgency overrides discipline? These patterns repeat until you see them clearly. The moment you recognize a habit, you create the possibility to change it. Without awareness, habits remain invisible and uncontrollable. With awareness, habits become manageable. Self-awareness also strengthens discipline. Discipline is not simply following rules through force. It is following rules because you understand the internal triggers that try to pull you away from them. When you know which emotions typically challenge your discipline, you can prepare for them. You can recognize the moment your mind begins to drift into old destructive patterns. Discipline becomes smoother because you are not fighting yourself blindly. You are managing yourself consciously. This makes execution easier, cleaner, and more consistent. Another powerful aspect of self-awareness is the ability to stay present. Most traders are mentally trapped in the past or future. They replay past losses, creating hesitation. They imagine future wins, creating greed. They fear future losses, creating anxiety. The present moment, the only place where a trader can make objective decisions, gets overshadowed. Self-awareness pulls you back into the present. You become tuned into what the market is doing right now, not what your mind fears or hopes. In this state, your perception sharpens. You see setups more clearly. You follow your rules more faithfully. You respond instead of react. Presence becomes a performance edge. Self-awareness also supports emotional resilience. Trading exposes you to disappointment, hope, uncertainty, and stress on a daily basis. Without awareness, these emotions accumulate and distort your judgment. But when you can observe your emotional state, you can regulate it. You can calm yourself during drawdowns, maintain humility during winning streaks, and stay steady when the market behaves unpredictably. This emotional balance protects your consistency. It prevents the extreme behaviors, overtrading, impulsive entries, revenge trades that destroy accounts. Your decision-making also improves dramatically through self-awareness. When you know your tendencies, you can design your trading system to protect you from yourself. You may add stricter rules, require confirmation, or limit the number of trades you take. You create a structure that aligns with your strengths and guards against your weaknesses. You stop trying to imitate other traders and start building a method that fits your psychological profile. Long-term success depends on this alignment. A strategy that works for someone else may not work for you if it conflicts with your emotional tendencies. Awareness allows you to craft a system that you can actually execute consistently. Self-awareness additionally opens the door to continuous improvement. Most traders analyze only their charts, rarely their minds. But long-term success demands both. When reviewing trades, you not only evaluate technical factors, but also your internal state. What triggered hesitation? What triggered aggression? What thought process led to the mistake? What emotion influenced the decision? This reflective approach transforms every trade into a learning opportunity. Even losses become valuable because they reveal psychological blind spots. Over time, this builds a stronger, more stable mindset capable of handling market pressure. Self-awareness also helps you build confidence, not fragile confidence based on recent wins, but deep confidence based on understanding yourself. When you know your patterns, when you know how you respond to stress, when you recognize your triggers and your strengths, you stop fearing your own behavior, you trust yourself to act consistently. You no longer worry about emotional impulses hijacking your decisions because you can see them coming. This internal confidence is more valuable than any strategy. It gives you the stability to stay committed, the calm to follow your process, and the clarity to move through uncertainty. Ultimately, self-awareness is the foundation because trading is not just about reading markets, it is about reading yourself. The market changes constantly, but your internal patterns remain until you bring them into consciousness. Once you understand yourself deeply, your emotional rhythms, your cognitive tendencies, your behavioral patterns, you gain control over the only thing in trading that is truly controllable, your actions. Through this control, you create the consistency required for long-term success.